So everyone, this is my good friend and longtime colleague, Phil Compton. Phil and I worked together for the first time, I don't know, before many of you were born.
Yeah.
98
Yeah,
was Wisewire? It is
exactly.
Pac-Man. So somebody noticed your name and said, "Oh my, it's Pac-Man."
Yeah.
Yeah, and so that's I won't go into it all, but part of Phil's lifelong email address is his initials, PAC, Phil A. Compton, and
That's
then
right.
that's made him Pac-Man.
That's right.
So anyway, Phil and I met, at a startup named Wisewire in 1998. And we were hired a very short time from each other. And I don't even know who was first. I think
You were.
but by like a couple weeks.
Yeah.
So this is the .com boom, and we were at a little rocket ship company that was doing very well, founded in Pittsburgh, and I was brought in to help scale the operations, the technical side, and Phil was brought in to arrange either further financing or a transaction, an exit for the company. And it turns out that an offer came in from Lycos to acquire the company uh, very shortly thereafter. So I was at the company 4 weeks,
Yeah.
and there was an offer to buy it. And Phil, I think you told me in your notes you'd been there 6 days. Is that right?
Yeah, just real quick. So I got a call by a venture capitalist that was probably the last money in there before they were acquired. And I closed my deal with the CEO and like the VP of strategy when they were on a deck out in California, I think. So I joined up over the phone, never had met them, and came in, and we had Monday morning management team meetings. So I was in my 6th day. I was actually in my 5th day and first hour. And the CEO was late. The CEO was late. And he finally comes in and he goes, "We just got the offer from Lycos." And I'm like, all these guys are high-fiving around the management team meeting table because they're all going to be multimillionaires. And I'm thinking, I barely know where the men's room is yet. And we're going to do an acquisition now. So that started about 8 months worth of big time emergency on my part.
Yeah, yeah. So anyway, rewinding a little, I'll introduce Phil and he can add more to it. So that's how I met Phil, and Phil has a classical education. So came out of, I actually don't know what your undergrad was in, Phil.
Accounting. So
Okay.
all of the CPAs are accountants. Yeah.
So super straight up then, a classical education in accounting, and then he worked for one of the big five accounting firms. The number of firms keeps changing because he worked for Coopers and Lybrand, which merged with Price Waterhouse and became Price Waterhouse Coopers. Um, and so, but after leaving that behind, after leaving sort of big five accounting or big four or big six, depending on how you count, he then had a short stint at sort of a mid-sized company, a company in Pittsburgh called Black Box Corporation, which I also knew. And then from then on, it's been all startups. And that is 1998 to now. I didn't count, but at least half a dozen different startups. You shared with me you've done over a dozen rounds of venture capital.
Mm-hmm.
And after Phil and I parted ways in Lycos, because we did end up being acquired by the search engine Lycos, we rejoined at another company. You'll hear some of that story, but what I really want to give Phil the opportunity to share is some of his experience raising money and from the chief financial officer perspective, which I think is a little bit different than the classic entrepreneur perspective. The classic entrepreneur has an idea and a dream. And I think Phil's experience is a lot making that dream reality and trying to make sure that the pennies in the piggy bank translate to the dream coming out into the world as real value. And so I think there's a lot to learn there. I will tell you, Phil, not surprisingly, we have several people in the audience on the venture side of things, where they work as analysts or in that world. And so they'll be very interested to hear, your side of the experience, because they're normally at the firm evaluating the proposal. And from to the degree that there's paperwork and heartache, they may be on the generating side of some of that.
Yeah, so I'll be mindful and careful of that subject then.
No, it's Twitch is a freewheeling world. We may just, there'll be interested people who may have the other perspective. That's all. Okay. So with that, if there's anything you want to add about your background you don't think I covered, you can. Otherwise, we can jump in and start talking about Phil sent me like 3 pages of stuff we can talk about, which of course we won't have time for all of it. Yeah. But we'll cover what we can.
If any of my former CEOs are on the show, which one or two of them might be, they know that I'm more wordy than less wordy. So that's not unusual. Just adding a little bit, I did meet Ethan in 1998 at WiseWire was the name of the company. We got acquired by what was then the precursor to Google called Lycos. We were acquired, 100-person company, $1 million in revenue at that time, and we were acquired for 40 times revenue. So those were truly the tech bubble days, whereas totally. the multiples now might be 2 or 3 or maybe 4 or 5 times revenue, but not 40.
Yeah, it was crazy. And the other thing, by the way, if you think that both Phil and I have been living on yachts since then, I won't go into all of it, but let's just say that wasn't very evenly distributed. I had a guy who, after that whole acquisition, I had an employee on my team who was going to vest 8 shares of Lycos stock over either a 2 or a 4-year period. So, and eight shares was not any big deal. So it was going to be, he was going to make a few $100s from that acquisition. Meanwhile, some other people who totally founded the company or were early, made a lot. So, tens of millions, right? The founder in that case, ended up with over $10 million, at the time of the acquisition. So it was just very unevenly distributed. And as truth will tell, so you all know, I ended up leaving Lycos before I vested anything to chase another rocket. So, but it was neat. So continue, Phil.
Yeah, so that's right. It was top heavy. There were a lot of multimillionaires sitting around that table, but and they started going golfing a lot while I was trying to conduct the transaction that would help them to get rich. So that was an interesting time. And then Ethan goes and joins another company and dials me up and say, "Hey, Phil, I found your next gig." I'm like, "Oh yeah?" And it ended up being a great next gig. So I followed Ethan and we spent another few years together. And that kind of went through all sorts of iterations. We raised a bunch of money. In fact, we raised about $60 million at that next company called CoManage. We raised Pittsburgh's biggest VC round to date at that point of about $40 million in 2000. The tech bubble started to fray and burst within a few months. I literally saw customers' contracts kind of sift through my fingers. They started debooking and canceling projects. So those were interesting days. We went from the tech bubble heyday to the tech bubble burst. And one of the next interesting steps along my career, and then we'll get to today, is I even as a CPA, I co-founded my own cybersecurity company in 2012 called Mount Covery Security. We closed 10 Fortune 500 customers our first year. So kind of back asswards, our best year was our first year because it was hard to keep that kind of pace up. So we sold that in 2015. That was, kind of a moderate kind of outcome. And right now I'm with a really exciting early stage robotics/autonomous vehicle company, which we'll get into a little bit more, but I don't want to keep taking up time with all the intros here.
Well, that's okay. Since you're on Zoom, can you swap your background on real quick? Because I think it would
Oh,
be fun, your corporate background, because it would be
yeah.
fun to talk about this just for a second. Because everybody, of course, obviously knows Tesla. So I'll just say I learned about, while Phil hunts for this, Phil's working with a company that's working on something I think really cool. It's this locomotion company. And what they're trying to do, ultimately, they're trying to automate truck transport to make robotic trucks. But I think they have a really clever, as a roboticist, and some of you have heard me before, I have some patents in robotic vehicles, even from Amazon. What I think is really cool about what they're doing is they have a plausible first step. And that plausible first step is to just get one truck to follow another. So if you need to get two trucks of stuff from A to B, you put them both on the road and you tell truck B, follow truck A. And, for many, many miles of highway is the simplest driving situation. Like interstate is the simplest. It's the most constrained. There's no cross traffic. It's long distance. It's blah, blah, blah. It's usually big lanes and all sorts of other good stuff. But it's really smart to me. And the other thing that's clever as a hack is I think they're going to start by having a driver in the second truck, but he can be off shift. He or she can be resting, or even, I don't know if Phil would say this, I will say it, maybe in some happy future, he or she could be sleeping in the cab. And then when you get to where the first driver's tired or you're about to leave the highway, you wake that guy up. And it's just very clever to me because you can obviously imagine if you're taking trucks all the way across the U.S. at the 12-hour mark or every 6 hours or whatever, you switch who's driving. And so you have rested drivers.
Yeah.
And of course, anyway, I just think it's really clever. And I'm hoping that they have a lot of success.
Yeah, and here, Ethan, you went undergrad to CMU. This team was with a part of CMU, the NERC as it's known, and 5 of them founded this company out of CMU, although it doesn't have any contractual ties. And they're basically deploying an AV technology in a following truck. So the lead truck will be driven by a human with all of a human's perception and decision-making efforts. And then the following truck is where the AV technology is deployed and eventually will be a driverless drone follower. So our tagline is we move twice as much product, twice as far, twice as fast. That's just a simple summary. And it's a much more practical approach than trying to boil the whole ocean like most of our competitors are, like a Waymo or an Aurora that others might have heard of. Although certainly great companies in their own way, they're trying to get to full autonomy eventually, whereas we're going to use a more staged, practical approach to get out on the road earlier, generate revenue, and have customer traction a lot earlier.
So not surprisingly, and I don't know what you feel comfortable sharing, Phil, and we may talk more about locomotion later.
Sure.
But the first question that came in on it was, what's their valuation? And I know that you're a private company, but have you press released anything about previous rounds or anything like that?
It's probably out there on Crunchbase, but I'm going to be kind of evasive. So it's sub 100 million. But and again, we'll get into things we're entertaining some much larger kind of valuations and transactions right now.
Yeah, I'll say, and I won't go into anything at the moment. Phil spent some time educating me on a new financing vehicle that's being used in the market that's very interesting. So let's rewind all the way and go back to the start. Since we advertise this as let's talk about venture financing and other things, where would you like to tackle the topic of raising venture capital? I think the first note in your set of notes says founders should start raising money the instant they think they have an idea.
Yes. Yeah, oh, and by the way, while I was being a little bit, I guess I'll say, downplaying of our valuation, we're in the unicorn conversation now. So sub 100 million to unicorn in just a few months, although it was more than a few months in the making, is we're really ramping things up right now. So any candidates looking for a cool technology company to join, Locomation in Pittsburgh. So yeah, if you remember, Ethan, Co-Manage was started on a written business plan, and got a $4.2 million valuation with literally not one keystroke of the product yet developed. So that's an unusual situation. That again was in the tech bubble days. That's not normal, and it's certainly not normal today. Although we'll get into the crazy amounts of liquidity and cash that there is out there seeking growth. So yeah, fundraising is both a pleasant, joyful, positive experience, and it's a constant albatross around the founder's neck or the founding team's neck, in that cash drives the whole business. When we started our cybersecurity company, we had 7 co-founders, which is a whole other discussion. That's about 4 too many. But we all BYOC, brought our own computer, BYOC, and didn't take any comp for an entire year. So 0 for a year is a long time. And we did raise money, but we said that we wouldn't take any compensation until we hit a certain level of bookings that would, turn into a certain amount of revenues. But my point is, that was unusual. Most people aren't going to come to your company for no cash compensation. So you just start early. Any round always takes longer than you think. I mean, I've done rounds. I've probably done not just rounds, but amounts of $10,000 checks up to $10 million individual checks, from $500,000 rounds to $40 million rounds. And the fact is, they're just all hard. They all have their own twists and turns and caveats and challenges. So any fundraising is hard, but what you want to do is get a jump start on it, try to compartmentalize it, find like-minded kind of investors that you can truthfully get along with, get that cash in, and focus on the business.
That's right, because from the entrepreneur's point of view, raising the money is not the goal. The money is a necessary input, but raising money enables work. It doesn't do any work. And obviously, we see high-flying startups who, I would argue Uber did some of this, where they raised so much money and they were famous for how much money they had raised, but then it took them a long time to get around to actually doing the work, having the work be present. So funding is fundamentally both incredibly important and a distraction from the point of view of the entrepreneur.
Yeah, and the CEO's job. In fact, I talk with my CEO every day, Chetan Marichli, who I believe is on the show, and an awesome guy, awesome and talented guy. his some of his main bullet points of his job are fundraising, hiring, and closing deals. So fundraising is right at the top, though. So it's a heavy burden. It's a heavy time suck, and you want to get it done as soon as you can.
So let's talk a little bit from the financial officer perspective. Often the very first round gets done by the founders, gets done without maybe a CFO in seat all
Right.
the time, and gets done through friends and family, gets done as an angel round, gets done all these strange ways. But once you're involved, um, what take us through as much as those 12 or more rounds you've done have a pattern. Kind of take us through the steps of what are the major things or milestones or activities that lead to funding?
Yeah. So I think most people on this show would know that there's some basic uh, characteristics that investors look for. Uh, the market is certainly right there at the top. The product is right there hand in hand, but the team and their ability to develop that product or service and excel in that market is really, those are like the top three things right there. So the market not only needs to be an interesting one, but it has to be, have enough girth, enough size, it has to be big enough of a TAM, if you will, that interests investors.
TAM is total addressable market for those who aren't. Most people will know the acronym, or many will, but if you don't, it just means we talk on this show, by the way, Phil, we talk about a common blog by a guy named Kevin Kelly. And that blog, that famous blog entry he wrote years ago is called 1,000 True Fans. And he does this math that says, as an individual, if you can find 1,000 people who will pay $100 a year for what it is you do, for your presence on a microphone like I am here, or your advice or whatever, you can make a tidy living as an individual. $100 and 1,000 people, $100,000. So he has argued you don't really need anything but 1,000 true fans. And that's true as an artist or an individual. But as a company, venture capitalists, and we have one here, and Phil can talk to it, while they all hope for unicorn-like returns, which means 100 times on their money or 1,000 times on their money, what would you say is kind of their minimum interest? If they're going to give you $1, what are they reasonably looking for back for them to be interested? What's enough of a potential return that they're like, okay, I'm interested?
I mean, I think they all, are looking for that 6 to 10 times the investment, knowing that they're not going to get that from everyone.
Yep.
And in fact, every fund, every fund's goal is to have that 100x return in there somewhere. Although that's kind of the unicorn that we talk about. So they're not looking to make market rates of return 8, 10, 12, 15, or even 20%. They're looking to make, like I say, 4 to 6x. I'm sorry, 6 to 10x to make the math.
Yeah. Now, as we all know, a lot of people here know at least this much about venture capital. It's a portfolio. Normally, what happens is they make 10 investments. They invest $1 in each of 10 companies. 6 of those companies, they get nothing or almost nothing. They get less than their dollar. Maybe 2 of those companies, they get their dollar back. One of their companies, they get $2 or $3. And then one company, they get $10 or $12. And so they total back getting $20 for their 10. And so they get 100% return, which is really good. I'm hand waving. But that 100% return still includes 5 or 6 total failures. And that's why it's there's a quote that says, venture capital is worse than gambling. Like, if you want predictable odds, go to Vegas where the odds are published. Venture capital has huge reward, but very, very unpredictable.
Right.
So I distracted a little, but I'm just giving some context on how venture works because we have a mixed audience. So, what if I'm an entrepreneur? How and I have someone like you, what do I need to do to help you raise money? Because we're going to raise money as a team. What do I do and what do you do?
Yeah, so that's a good question. The CEO is typically the sales guy, bringing in the leads, if you will, and they'll spin up the interest and be more of the show person, if you will. And I tend to be the person that they throw the deal over the wall to then orchestrate or be the mechanic of it. So CEOs are typically more subject matter experts of the product and industry anyway, and cheerleaders by nature, if you will. Whereas I tend to be more of a mechanic and technician on the back end.
Okay. Uh, Excellent. And so, one note there is if you're a technical business founder, because I come from a technical background, you either need to have developed enough ability to sell your company on its own, or you better bring in a partner who's got the gift of gab.
Right.
Because while it varies, how many doors would you say you knock on, or how many venture capitalists would you say you pitch? Maybe what's the high and the low in those rounds you've done?
Yeah. Oh man, looking back 25 years, uh, I would say the hit rate is something like one out of 50, probably one out of 15 to 20. Now, that's when you're starting the company. I'd say a hit rate of one out of 15 to 20. Sometimes it's a lot higher. And then other times you're starting a company with a known track record, and maybe you've got a whole team of people who have a track record, and you're able to just make a few phone calls, and you've already got, the core of your investor group formed and interested. But I would say it's hit and miss until that first investor takes a step. And then there's this thing called FOMO that starts kicking in. And of course, you have to have, again, the attractive market, the attractive industry, the capable and respected team. But assuming you have that and you've got your first investor of any size in, others will start to take note. All of a sudden, you're a little more attractive, a little more sexy. And then you bring in a couple more investors and maybe even one with even a kind of a mediocrely well-known name. And now you're somewhat off to the races. So, no one's interested until they are. And sometimes it just takes that initial domino or two to be knocked down to then unleash a lot better hit rate.
Um, so, one question that comes from that, maybe a story you want to tell. You were telling me of a time where you had a very hot round and finally a bunch of people wanted to get in, and you actually had venture capitalists you'd kind of never heard of then calling you up proactively and asking where they could wire money to participate. So it totally flipped from are you interested? Are you interested? To people calling you that you didn't even really know and saying, where can we send money? Talk a little bit about that, just because it's a great story.
Yeah, it's so we were raising our biggest round at this company. We'd raised three previous rounds, and this was going to be our biggest. And the insider investors had not been completely maxed out, but none of them were going to lead the next round. So, and by the way, these, and I know investors can take different shapes, but we're somewhat talking mostly about VCs, I guess.
Yeah, well, we can talk about angels and other things too, but yeah, we've sort of gotten onto the VC track. Go ahead.
So VCs typically invest a certain amount in their first, round with you, and then they'll hold back about another 50% on top of that, another, so it's 1.5 times in total, another 50% to add on or participate in future rounds. because the assumption is they were so interested to invest in the first place that they'll want to keep investing as you raise more money to keep their percentage at least at a desirable level, if not even a contractually protected level, which would be called a pro rata level. But at any rate, they'll keep some dry powder, you might hear them call that. So we were starting this next round of financing. It was either the third or the fourth, and we didn't really have a lead yet. But then a little firm called Goldman Sachs, we got them to come in for $10 million. And that's when it got a lot easier, because Goldman Sachs declared themselves with a stake in the ground as they're the lead. They're putting in 10 million, and we're looking to raise about 35 million. Well, the CEO and I started getting contacted by a lot of different firms, some of them big, some of them small, and we reached our target of 35 million. Then I started getting calls of, hey, Phil, this is so-and-so from such and such firm. We've heard that, you're raising around and Goldman's in. We want in. I'm like, okay, well, who are you again? And what's your firm's name? And what's your contact information? Because I'm going to send you a private placement memorandum so you can, look at all the information and our projections and description of the business and risk factors. And they're like, oh yeah, that's great. What we need are the wiring instructions. And I said, no. I have to send you this as for an educational and information purposes. You have to sign it as declaring you have read it and understand the risk involved and that you're an accredited investor. Then you can invest, or then we can consider your investment. So that 35 million, well, that round that was hard to start, that was then jazzed by 10 million from Goldman Sachs, that reached the $35 million goal, ended up at about $40 million in the end. Oversubscribed, yep. They call it.
Yeah, oversubscribed. It's this polite word for people wanting to give you money and you actually turning it down, which is a great place to be in.
Great place to be. Doesn't happen that often.
Doesn't happen that often. And Phil and I were at that company together. It was co-managed corporation.
Yeah, no harm in saying it.
Yeah, it's long ago now, over 15 years ago. And I will say, some of you who watch this channel a lot have heard me tell this story. I'm going to tell, Phil's probably not heard my perspective of this story. I was a vice president at the company, VP of operations. And frankly, I had done something I recommend to anybody who can pull it off. I was not a founder, but I had weaseled my way into sitting in the board meetings in order to be able to get an education. And so it turns out right after they raised this round, they got wise to like, who's this guy, and threw me out. But I got to sit in to the board meetings for the first couple of years of the company's existence. And anyway, I was in the room. This was like a huge bubble statement. I was in the room when the Goldman Sachs representative said, well, your only job is to get big fast. That was the watchword of that generation of what created the bubble. Is this guy's like, we're giving you lots of money. Your only job, don't focus too much on other stuff. You need to get big fast, grow, add people, add market, make sure you're moving fast. And the irony of that, which I'm sure Phil will choose where he wants to talk about this, it's kind of an argument about managing your growth, is I owned recruiting in that company. And over the course of the next year, I pulled off something in recruiting I'm still very, very proud of, which is I hired a recruiting team and used novel recruiting tactics and grew the company from 50 to 150 between 2000 and 2001. And so I tripled the size of the company, which was all part of our plan, and added 100 great people. And then the dot-com bubble burst, and shortly after that, 9/11 hit. And we first laid off 50 people, so a third, half the people I'd hired, including myself. I've talked about how I got myself laid off.
Yeah.
And then later, after I was gone, we laid off the next 50. And so in 6 months, really in 4 months, the company undid a year of my work. and the whole Goldman Sachs get big fast thing became like a bad joke in hindsight. So that was my experience of it. But Phil, talk a little bit about your journey through that and some on cash management or proceed management, because, I want to be clear. Now it's a long time ago and all those people are doing fine, but it was a human disaster. We were importing people into Pittsburgh because Pittsburgh didn't always have all the talent we needed. We were relocating people. They were uprooting their families or betting their futures on it or leaving other jobs. And then everyone, including myself, got laid off and into a very difficult job market. And I remember we had to call one guy. I won't give his name, but we had hired him as a manager. He was going to be a dev manager. And he was due to start in like 2 or 3 weeks. And we called him up and we're like, you know what? Things aren't going well, and actually, we're not going to bring you on board. And I think we may have given him a package because he'd like already left his other company. But we're literally telling this guy who's like in the process of moving, like, just kidding.
Yeah.
So in that case, I was a young leader, and I was part of screwing this up. It was done with good intentions and done, ironically, at the behest of our board member, but that's no excuse. I'm not making any excuses. I and many of the other leaders were young leaders, and we made bad choices. But we didn't know better. This was my first time leading a startup. Not an excuse again. So Phil, you were there. Talk some about, both the good and the like financing, and then also the what you would share from those lessons.
Yeah, well, I was at the financial steering wheel. So the CEO and I actually shared an office elbow to elbow for 1.5 years. So I would say, with all due respect to the VCs that were involved at that point, that they pushed us, as you said, Ethan, to hire the best people we can as fast as we can. And it was literally the statement that you'll hear, build it and they'll come. So we even remodeled and refurbished, the facility we were in. I do remember we had an 8-member management team. And when we talked about refurbishing that building and building it out, I got up and said, hey, we've got to remember we're spending, invested money. This isn't our money. We don't really have revenues yet. And they all turned to me and they said, Phil, you CFOs are always worried about cash. This is about image. And I actually left that meeting. So it was 7-1, and I voted with my feet against building out that building like we did. But anyway, one of our employees also wanted to put in a climbing wall in the lobby that was going to be about 10 grand. And I said, you know what? Why don't you suggest that to the board yourself? I'll just let you come to the board meeting and you make the suggestion. He's like, well, I don't know if I want to do that. I'm like, exactly. I said, if things go south, that's in our lobby. We'll literally have to spend $2,000 to tear it out of there. It'll be a symbol of waste. Thank God we didn't do that. But again, the VCs really did say, and they came in, the CEO in my office, and said, your main job now is to, again, hire as many good people as you can, as fast as you can. And he turned to me and he said, Phil, I know you're stressed about cash flow. I know you're stressed about revenues. He goes, this is a time in history where you don't have to actually worry about that. And I thought to myself, I didn't say anything to him, but I said, I must either be dumb or this is the twilight zone. So it was actually hopefully more of the latter, in that it was just a very unusual time in history where size mattered, team size mattered, and of course, product development progress mattered, but the financial side of the house didn't matter as much. Again, there was more dry powder where that came from. Don't be stressed about the money. And that was after we just raised a big amount, and I was still worried about it. But at any rate, I don't think we made that many mistakes. I think we were in concert with our investors who assured us we would get more financial support after we built that team. We did, in fact, build a very good first product that we sold. In fact, if you remember, our first contract was with Sprint's long distance division through an OEM called Metasolve, and that original contract was $6.5 million. So anyone would take that as their first deal. Then we closed about 6 months later. We closed AT&T Wireless for about 2.3 million. So those are two great first contracts. I think then, and we kept signing up some customers, but I think then, boy, the market really started to turn. And I remember, and I don't mean to ramble here, but I remember one day I got a call from a new customer down in, I think it was Hollywood, Florida. And he goes, "Hey, Phil, you know that system engineer you guys hired in Florida here about a month ago for us?" And I'm like, "Yeah, he's going to be great." They're like, "Oh gosh, well, I wish you hadn't done that because we're actually going to have to delay our project." I'm like, "Well, what's going on?" He goes, "Well, in all honesty, we're going to have to cancel the project." I'm like, "Cancel? I already reported to the board we have this booking." He goes, "Well, in fact, we're going to go bankrupt." I'm like, "Whoa, whoa, whoa." So he actually just decided to open up and say, "I'm not going to screw around with you. We're going out of business." And I went into the CEO and I go, "I don't know what the hell just happened, but here's the story." Within about 2 weeks, we got another call similar. And what we were seeing is the disintegration or the bursting of the bubble in front of us. There wasn't a press release. It wasn't like on CNBC, the tech heyday is over. It just started happening at people's desks. And it was almost like, it sounds like I'm describing a contagion. And that's actually what it almost felt like, was the dominoes just started falling down financially. And that was how the tech bubble burst came about.
Yeah, and for a lot of the audience here, because a lot of the audience has come of age during our roughly 12 to 13 year bull market since 2008. I'm not a stock market prognosticator. We might have 10 more years of bull market. We might also have 10 more minutes. And just it's worth understanding, many of you have not seen a big pullback. And at that point, Phil might have. He's more into the financial community than I am. I had never seen one. I came of age, and things were good and got better, and they were great for many years, and then shit went south. And the only thing you can guarantee for sure is that it will go south once again. Markets are cyclical. There is no magic where things will forever go uninterrupted up and to the right. Now, does that mean that I think we're in a big tech bubble now and you should write down all these predictions from me? Hell no. What you should do is be aware that current market conditions can shift. And I think what I learned from this that I would share with the new entrepreneurs is, whether you have a little bit of money or not, some people in chat are talking about bootstrapping versus not, and big investments and not. Having a bunch of cash in the bank and having a low burn rate and income gives you so much more option value, because you can go faster little by little as success manifests. And if things go wrong, you can go slower. Whereas if you get a big expense overhang, Phil will tell you, this is like another interesting point. By the time we started laying off people, so we went from 150 to 100 to 50, how much office space did you have? How much seating capacity did you have in those buildings?
Probably enough for about 225 or so. In fact, if you remember, we were going to put a second story on one of the wings, and thank God we didn't do that.
Yeah. So we literally we were in two adjacent buildings, one which was like a 3-story kind of cube, and one of which was like a partially 1-story, partially 2-story, and I had actually forgotten that.
Yeah.
But we were getting ready to build, physically build. This is old times, a 2nd story onto the building. And no doubt after I had left and after all those other people left, it had to be like a ghost town because we had seating space for 225 and the company contracted to 50. Now, I know they started immediately trying to sublease that, but like Phil's paying the bill on seats for 225 and he's got 50.
Yeah, so I erected a sign out in front of our building that says, for cool tech space, email or call Phil Compton. So I became a master sub landlord, and I probably subleased out to about eight or nine companies, and 2 of them are still there today. That was 2001. They're still there in 2021.
Yeah, funny story. Of course, we let go of my recruiting team because why did we need recruiters? And those 2 recruiters who were fabulous and are friends of mine to this day turned around, formed a partnership, formed a small company to do staffing in the city of Pittsburgh, leased space from Phil. And I don't know if they're still there, but they're still in business as a recruiting duo. So there are some happy endings, but yeah, they were one of the tenants right back in their own offices.
Yeah, in fact, one of them has reached out to Locomation and may do a little bit of recruiting for us. So you never know what's going to come back around. Oh, by the way, in putting on that 2nd story, I won't name names, but someone talked about putting a sliding board in to slide from the 2nd floor to the 1st floor. That didn't happen.
The funny thing about that, I honestly have no idea if Phil's politely referring to me because for all I know, that was my.
No. Hey, I do want to back up real quick here and say that as an engineer, I was, and I don't have to say this, but I mean it. As an engineer, I was so impressed with Ethan as probably a early 30-something engineer and a talented engineer, how he really was almost kind of a COO for our company at Co-Manage. And there really wasn't a subject or an area of the company he wasn't willing to jump into. And when he jumped into, he completely grabbed onto and owned it. So very process oriented, very thorough, and I'll take the chance to work together again any day.
Yeah, Phil and I worked together twice. Phil, that's wonderful praise. What I'm sad about is I look back and say, oh, what an idiot I was. Not just about the money stuff, but just I was very eager and hardworking, as you say, and I had knowledge, but I didn't have experience. And so what I try and share with people here is experience. So with that in mind, we've talked a little about how to raise money and the fact you should start early and you need to have a good case and that you're going to have to talk to a lot of people. Let's talk a little bit about use of proceeds. So for those of you who don't speak the exact lingo, use of proceeds essentially means when you're given the money, how are you going to use it? So when someone invests in you, what are you telling them you're going to do? And I think, Phil, maybe talk a little about what you've learned is the right way to spend the money.
Sure. Yeah, so it's going to mostly be on people and tech.
Yeah.
People, personnel costs, that being wages, base, variable comp, benefits, insurance, 401k, all those things usually comprise about 65, 68, maybe 70% of a company. More so in a software kind of company where your most prevalent asset is in fact people. In a more hardware-based company, it might be a bit more capital intensive, but for the most part, the majority of your costs will be people or team oriented. So along those lines, I have a few comments. And one is outside of the founding team, I would tend, and I didn't used to think this way in my early career, but I would tend to think about hiring contractors and not employees where possible for a while. And I say that because, as Ethan has kind of mentioned, which I don't think he was made, missteps like he might have felt he did. When you're earlier in your career or anytime in your career, you don't always make the perfect hiring decisions. And once you've got someone on board, there's kind of you've got the area above the water of the iceberg, and then you've got the area below the water. And people's cost just isn't how much you're paying them per paycheck. It's all the benefits, all the overhead, all the management time that you've spent onboarding that employee and getting them integrated into the company and training them and having them, get so immersed in the company and taking on things that maybe even no one else can do, that if you are forced because of a bad hiring decision to, extract that resource, there's a whole other tail of costs that you have to incur to get back to where you were, just to get back even. So I would tend to try to use independent contractors or consultants where you can, with the caveat that in certain roles, you want to have cumulative knowledge that you don't have to want to retrain someone. So, you wouldn't want to, I don't think, contract for your main product architect, because you want them there from cradle to grave in the development process. You don't want them to come in, kind of come up with the specs, fulfill the requirements, architect, design, hand it over to development, and then walk away, because they're the sounding board against which you then want to measure your progress. But I do think, again, with people, I would tread a little bit slower, hire slower, fire fast, course correct and correct mistakes when you find them. A comment there might be that if you bring in anyone that's clearly not a team player, or maybe even has a toxic effect, I would extract that out right away. I wouldn't mess around. I tend to have a pretty quick trigger now. And I think eventually you can have a little bit of the luxury, once you've grown to maybe 50 employees plus, that you can start, identifying those that aren't at the A player level, or maybe B, but rather at the C level, that you'll kind of call and replace. What was it? Jack Welch was known as, was it Chainsaw Jack or Buzzsaw Jack? He actually forced his managers every year to grade his employees. And he said, if you're not going to get rid of the C players, I will. So your choice or mine. I'm not suggesting that tactic, but the theory is own up to hiring mistakes or missteps as early as you can and correct them. But again, people are your main cost, and that's where I would focus on a lot. I can keep going, but I'll stop there for now.
Well, it's good. You've engendered a lively discussion in the chat thread about personnel and about the process of firing. I've done other shows on hiring and firing. I've talked about a little bit performance management, and I certainly I've done more than my share of downside performance management. One of the people says, by the way, he was known as Neutron Jack.
There. I knew it
Yeah,
was something explosive.
yeah, and thanks, Pentaquan. Um, so anyway, though, the point, people in the channel, sometimes they are at the individual contributor level, and and I understand this for viewers that it's uncomfortable to hear two C-suite executives talking about you like pieces on a chessboard that we're going to move around and sweep aside when convenient. Of course, we're not trying to be heartless dicks. Um, but instead, there is a reality that if someone is dragging the company down, the thing you're always worried about is this one person going to make the difference between the whole company doing well? And so what you have to do as a leader is you have to ask, can I mentor this person, or am I in enough of a survival situation where I unfortunately have to ask them, ask means tell, by the way, where I need to tell them you're going to need to go work somewhere else because I can't afford you right now to invest in you. And you obviously always want to be humane, and this is why Phil's talking about hire carefully, because letting someone go is a terrible activity. It may be necessary as a leader, and in fact, I agree with Phil. You have to be quick on doing it, but you want to try and avoid needing to do it. And so it's this dichotomy of how do I maintain that option value and only hire people I feel like I can keep a commitment to. And then sometimes, somebody in chat, one of our regulars, says sometimes a person is needed from step 1 to step 2, but they can't cut it for step 3. That's also true. Is not everyone can grow to every scale. Bottom line, you want to be careful who you hire because you don't want to have to let people go. And at the same time, when you get to that point where you need to let people go, whether it's for performance or just company reality of finances, you're better off. It's a little bit like ripping the Band-Aid off. You can peel it off really slowly, but that won't help anybody. It's painful. Like in this case, the Band-Aid is a living thing, and it's painful for both you and the Band-Aid. So I think that's good advice, Phil. And the thing I would summarize what you've said about use of proceeds is this. The burden of a CFO and a CEO is they need to make the choice between where to keep optionality, to keep money available and to move slowly so that they have flexibility in the future, and where to make bold bets. And where to say, okay, we have something here and we're going to take a risk and invest more. And that's why they stay up late at night and worry. And probably a lot of them have acid reflux disease because you succeed or fail based on that. And I don't know how Phil would count his track record. Co-Manage eventually reached an exit. It was acquired. But it was not acquired in a way that paid back many of the investors. Well, I don't think anybody got all their money back. And a lot of people, some people got none. I don't know his track record across startups. Some of them exited very, very successfully. Some of them didn't. Right. I don't know. Maybe yours didn't. Some of the ones I was in certainly didn't exit very well. What makes the difference between a good exit and a bad is how careful you are, and then how good you are at calling that when to gamble.
Yeah, I think you're right. There are advisable or good investments. I mean, it's not like a CFO's job is to always say no. In fact, I've actually met some peers that say, and I've had more than one say this, I like to be a CF no. I'm like, that doesn't sound like being a very fun person. And, I keep my door closed a lot. So in other words, they're trying to be hard to deal with or hard to reach and, almost create an aura of, well, don't ask the CFO for this.
Yeah, that's not helpful.
Yeah, I don't feel that way at all. In fact, Jack Waters, John Donnelly, any VP of sales I've ever worked with up till today, I've always been hand in hand with the leader of the sales group. And I might say, this deal has a little bit of fuzz on it, a little bit of hair on it, but why don't we figure out how we can tweak some of this and figure out how to land the deal? Because in the end, you could call me a bean counter, but I'd rather help bring in the beans as well. Um, further on people, and we don't want to make this a show about people, although we could. I do think you have to be open and communicating, and remember to say thank you. How are you doing? Do you have everything you need? If there were one or two things you'd change, what would those be? I think you have to be encouraging and nurturing. And I know, Ethan, with the some of the practices and activities you're involved with, you're really kind of a career coach of sorts at this point. So you would believe in those latter statements, but it's not all, watching people, and if they make a mistake, whack them on the head.
No.
It's just trying to, make sure you've got the right people in the right place with the right fit.
Yeah, we talk a lot about, in other shows, I talk a lot about how to get voluntary effort from people, because in the end, you need people who want to work and who are excited to come to work. And we had lots of that in our shared companies. We also just had, like any large enough company, you have some people that aren't working out. So,
Real quick,
yeah, go
one
ahead.
more thing on people, a little bit of juice here, I guess, or a little bit of flavor. I've often in my career, I've had people kind of dumped in my lap from an HR point of view, and let Phil clean up the mess we just made. So I've actually been threatened. I've been challenged to a fight in a termination. I've had a spouse burst through the door. I've had people cry, pound the table. So I've been through a lot of different interesting situations. And I usually have that calming effect, which is why these people brought the mess to my door in the first place. But uh, you can face some interesting things with people.
Yeah, I've been lucky and never had like the very worst. Um, but I've seen it. I've seen, yeah, I don't know. And you get it, right? Well, anyway, you get it in this sense. People's careers are very important to them. They're part of their identity. Sometimes if you're being let go for business circumstances, as I was when people have heard this story, but I put my name on the termination list at CoManage. I talked to the founder and I said, look, I've been leading growth and we're not growing. Like, I'm expendable. And I had another job opportunity, so I knew I could land safely. That's like an ideal circumstance, but a lot of people don't have that. And so it's an emotionally threatening thing. They may have just bought a car, or they may be expecting a baby, or who knows? And you're giving them, other than telling them, being a doctor and telling them they have a terminal disease, telling someone their employment is at risk is one of the hardest things you can do.
But do you know, in the ensuing months after those layoffs, Dave Nelson and I, the CEO, got a number of emails, even paper letters from people that said, you know what? I've gone on to land at such and such company, and I just want to say thank you for how respectfully you treated us with the moves you had to make. And I'm now realizing how good we had it at CoManage.
Yeah,
So
they end
you
up
can feel
somewhere
good about
else.
it. Yeah.
Not all employers are good, and we talk about that a lot on the show. So, Phil, if we could, I'd like to switch to taking some people's questions. And we have a little tool here on my end that lets people vote on questions, and they've upvoted some questions.
Okay.
So the first question is, how important is it to have an investor that aligns with your company's goals and mission? In a world where profit is king, would it be worth working with an investor? In a world where profit is king, would working with an investor with better terms be with it? So I guess the trade-off between the easiest or best terms and the best alignment. How would you say about what's important in investor relations? I know you have thoughts on this.
Yeah, I think my quick response is I'd go with the one that I felt better about and that I thought was more emotionally attached, if that's the right word, that, like you said, believes in your vision, that will be there to support you when times get tough, because they at times almost surely will get tough. And those terms can be overcome with performance and success, whereas someone's behavior or mindset or motives don't usually change. You're not gonna change an investor. You're not gonna change an adult, but you can improve your lot with terms, if you will, through successful results and performance. So I'd go with that investor. In fact, I would turn, how investors perform their due diligence and seem to ask you all the one-way questions. I would encourage you to have your set of questions that you ask your investors to elicit and get a picture of how they're going to behave when it comes time to, as I say, maybe do we lay off people or don't we? And you can, in today's connected world, you can probably find an entrepreneur or someone who has dealt with an investor or a firm and get, kind of a backdoor or unsolicited recommendation or opinion.
Yeah, I would agree with that. So you can normally get information, but I would absolutely check references on an investor. And I would not feel bad about checking references on an investor.
And I've been with founders, I guess I'll say CEOs, who have had great relationships with their roster of investors. And I'd include my current CEO, by the way, who's done great at that. And I've been with a couple that have just been very combative, and don't you dare talk to one of our investors. Everything goes through me. I'm the only one worthy of speaking with the investors. And what you'll find when that kind of attempt to retain control happens is the investors will pierce through that and reach out to people like me and say, Phil, I want the real story, because I'm not getting good vibes from your boss. And that's a pretty serious thing to have happen. But for the most part, people are chummy and friendly with their investors, as should be.
Yeah, and all of this, of course, presumes, let's be candid. In order to choose between investors, you have to have more investors than you need. And that's a great step. And there were some people in chat earlier who were talking about having a great company that's easily fundable. Yeah, if you have an extremely strong team and you're profitable or have initial revenue, you're going to have a lot more choices than if you don't. But in the situation where you have the choice between investors, I would absolutely choose the one that's aligned. And I think Phil has a great anecdote. He's got an anecdote about two angels. I guess I'd call them angels. One of them was a really big angel. But he's got some anecdotes, he won't use names, about one angel who was pretty high maintenance and one angel who was no maintenance. And just to give a contrast, maybe tell those stories quickly, Phil.
Yeah. So at one of my companies, we had an early but small investor on the cap table who put in a little bit of money and, always ask a lot of questions. And I'm usually investor relations at a company, so I always fielded his questions. But sometimes he'd ask me a question, then ask the CEO the same question. And it got to where he was actually he showed up to our offices, I would say 2 or 3 times at the front desk and just said, "Hey, I'm here for Phil and Dave." And we're like, what? Did you make this? Did you make the appointment, Dave? He's like, no. So we might spend an hour, hour and a half, 2 hours just out of the blue for a small investor on the cap table. At another company I was with, wealthy individual, just a super talented CMU grad and very nice guy. His he was, and I told Ethan, he was always the fastest or the first with his money. He asked the least questions, like 0 to 1 questions, and he was just a joy to work with. And he was an emotionally attached and supportive investor, and he wasn't looking at it from the financial metric minutia that a lot of investors do. He was more like, I believe in the industry, I believe in the product, I believe in the team. Here's my money. I'll kindly get out of the way. Let me know if you have any problems. So there's the spectrum of investor overhead, I guess.
Yeah, and somebody here has asked the question, how do you handle some of these taxes? And I think the only way to handle it is to set a structure with the VCs and any investor, angel, it doesn't have to be a formal venture capitalist. There is a structure. There's a board. You're either on the board or you're not. If you're on the board, you have certain rights. If you're not on the board, you have certain rights. And you need to set up front with people, look, of course we want to be a good partner with you, but you have to understand answering your questions is not our job. And in fact, we protect your money best by doing our job and sticking to the structure. And a lot of this has to do, I think, with, it's like any management situation. You set expectations up front. If you train an investor that they can show up at the front door and ask questions, why wouldn't they? If you train an investor, well, there's a board, and either you invest enough money to be on the board or you don't. And you're welcome to the board report. And, you know, we have a way to answer your questions, but you don't get to just tax our time. Now, you want to be super polite to people because the investment community is small. But it's like managing anyone else. You have to set guidelines. And I think, not Phil's fault, our CEO at that company, who was a good friend of mine and a colleague of Phil's as well, he didn't like to tell people no. That wasn't his first favorite job.
Right. Yeah, but you know, I will say that you're right. You do have to be very deferential and respectful to investors, and you know, you kind of have to be more tolerant than not. And for the most part, everyone's fine. I mean, it's a few percentage of investors that might be a little bit, you know, more overhead than others. It's not real common, but when they are, they can be a little bit of a pain. But for the most part, they're okay.
Yeah, so we'll move on to the next question here in a second. But what I would say about this is it's usually the small investors, usually, that are the more pain in the ass.
Yeah.
And the reason for that is if you bring on your mom or your brother-in-law or your sister's cousin twice removed, they feel A, entitled, but B, they may have mortgaged the bank or put part of their retirement money in. And if you get an angel who gives you, you know, whatever, that angel has some money, and let's say they have $1 million, part of that's in their house and part of that's in their home, or what, you know, or in their bank or whatever, but they put $50,000 in with you. That's a big chunk of their personal money, and they're imagining like that's their Tesla they didn't buy, and so they've given you their Tesla, and they're going to keep asking you, what are you doing with my Tesla? The professional investors are a little different. And may have at least some more understanding of the appropriate venues. So we have one other question that's had a ton of interest here. If people watching want to vote on other questions, we'll definitely cover them. But the next question that's got a lot of interest is looking at tech IPOs, especially Airbnb, performance of Tesla, and general historical highs in stocks and indexes. Do you think we're nearing another stock or tech bubble?
Yeah.
Now, neither Phil or I own a crystal ball. Yeah, I'll give him some air cover to say, if Phil or I knew when a tech bubble was coming, we'd go invest in some short options, and then we'd go buy an island. But So we don't know, but is there anything you'd like to say on this, Phil?
Yeah, it's crazy the amount of money that's out there. And I think some things I would point to while not being a Wall Street analyst are that there's so much liquidity in the market right now. I mean, the Fed's practices of low interest rates to almost no interest rates to purchasing government, issuances and bonds, and obviously the actions that the government has taken, the Treasury has taken to put money into the economy, although we're in a very unusual economy, let's face it. But there's so much, you hear about this, there's so much money on the sidelines, and with rates so low and the relatively few amount of deals, there's a lot of money there's a lot of money chasing a lot a lot fewer deals.
Mm-hmm.
Get that out of my mouth here. So I think it's supply and demand. The supply is massive, probably historic. I'm sorry, the demand is massive, probably historic, and the supply is relatively low in comparison. We hear a lot ourselves. Investors are starved for growth. They don't want 1.04% on a 10-year note, which that was today's rate. I think that's the highest in 15 months. So they're looking for growth. They've got a certain amount of their allocation allotted to alternative investments, which would be like what a VC and kind of investment is. And they're out there hunting for the next exciting deal. I heard on CNBC this morning, if I heard this right, I think, and I didn't look it up, Tesla's market cap was like 70 some billion in March. I think it reached 770 today. So that's 11 times in 11 months.
What we can say about an example like that to make it concrete for people, whether you think Tesla is great or not, their actual asset value, their actual production, number of cars, number of employees has not gone up 11-fold in that time. Mm-hmm. So what you have to believe in that as an example is that their future value, either they were very undervalued back in the beginning, assuming that Phil has the right numbers, or their future value, people are borrowing against their future value and they're buying now into something they believe Tesla will achieve. I'm not here to talk one way or the other about what Tesla will achieve at this moment. I'll just say, though, what you do have to understand is that isn't real. It isn't, sorry, I want to be precise with my language. It isn't tied to actual income or order growth. It's tied to belief about the future. Yeah, it's all speculation. Somebody in chat says all speculation about future value, which may come true, and it may not. And that's just, you have to recognize that that's a speculative situation. So I will just say a little. Oh, go ahead, Phil.
And I think Tesla and Bitcoin are probably two of the biggest outliers we possibly could talk about. They're both, in that category of irrational exuberance that was mentioned in the tech bubble heyday. Those two right there are very unique.
Yep. And the stream knows, I think, but I'll be clear just in case. I do own some shares of Tesla. Phil knows that. I've had them for many, many years. So I'm all for Tesla going up. But I'll also say I'm not currently acquiring more Tesla.
You can already buy that island if you've had it for years.
Yeah. If only I had enough of it. And so, let's talk about this a bit more, though. I will go a little bit further out on a limb, and I will say this much. We've been in essentially an expanding market since 2008, so 12 to 13 years. And that's a long time. If you just look at historical comps, that's a long time, and markets are cyclical. So again, I can't tell you we're in a bubble today with surety. I happen to be suspicious we might be, but I can't tell you we are. What I can tell you is there will be a downturn. And many of you watching were not paying attention to financial markets in 2008 or 2001. And, that neither was I, right? When 2001 came around, in 1999 to 2001, I had never seen a downturn that affected me because I was young and didn't know. So anyway.
Yeah, I just think that, and again, there's a lot of people hurting. This virus has been unbelievable, and that's a whole other show. In fact, you've had shows that talk about the virus, but we're on the downslope of this awful mountain we've had to go up and journey up and down. And I think, like a lot of people a lot smarter than I do, that come about mid-year and on, we're going to see great growth here in the U.S., probably worldwide. So the stock market, it's a place where you pretty much got to be. And you don't want to wait until, it's too hot to invest. It's already extremely hot, but by most estimates of analysts, it appears we're in for a pretty nice, market year for the market here.
And this is a great point. Phil just told the bullish side. He just told the bull story. So if you want to tell the bull story for 2021, you tell the story of there's vaccines coming out, there's pent up demand, there's lots of capital. For better, there's currently basically world peace. Like no major countries are actively at war. And we're surviving through the pandemic, and there's going to be this huge rush as world commerce and world travel resumes. And wow, times are going to be great. If you want to tell the bear story, you would tell the story that says, the pandemic's going to drag on for a while. Governments have been borrowing, so they're deeply in debt to support failing economies, propping up unemployed people and closed businesses. And that's going to come home to roost. And, whatever else you want. I can tell the bear story that eventually the hangover of all the borrowing and the long expansion and the lack of employment is going to lead to a protracted contraction. Someone in chat mentions the number of restaurants, that aren't open. You've got all this empty commercial real estate, and I can tell story after story about why that's going to lead to contraction. This is super hard to predict. I probably will have, we've had some finance professors on before, so I'll probably have some academics on maybe in February. I'm working on that show to talk about it. But I guess I would just say people's track record of predicting future finance is poor. If you look at the long-term track record, it's not too great. It's roughly equivalent to election pollsters, I think.
Yeah.
So I hope Phil is right. I don't wish for downturn. Ideally in a perfect world, you would see faster growth and slower growth. Like you'd see the cycles would all be positive and great financial management by our government and other governments would keep us from ever turning into a deep, recession or depression. But it's unclear. So, all right. So let's see. We have a couple other questions that have just a few votes. I'm going to look at those and see. We'll take the next one, I guess. We'll change topics here. I'm the co-founder of a meditation app startup that I'm growing on the side. We have traction, and I'm considering finding investors to add fuel, but I'm concerned about how I'll be perceived running this on the side. I don't pay myself or my co-founder. I think this is a great question, Phil. To me, the answer is straightforward. What would you say? This is about someone, I think the question is seeking venture funding, yet still, maybe even after trying to do that or seeking investors, running it on the side of another job?
Well, if you've never, I didn't catch in there if they actually have a product out yet, but it certainly sounds, just in the little bit of info I got there, that it's too early to be approaching a VC. I think I would, try to continue to put your own efforts and money in and deal with kind of the family and friends kind of approach before I would even contemplate going to a VC. Again, I don't know the scope and the breadth of what you're developing, but if it's still in development, I think I would try to be more capital efficient and
So
not.
that I got a little more data. The person who wrote the question says the product is out and makes money, but not enough to pay two people full time. So he's got an app out and it's bringing in some limited income.
Okay, so still not very big though. So I would just kind of keep doing what you're doing, get more traction, get more users. Uh, I don't think at this point, you're. I don't even think anywhere close to talking to a VC from the little bit that I know.
Yeah, so I would add to that and say the biggest thing that I was expecting Phil to address, basically no VC. Okay, we're going to take a pause here and say if you're Elon Musk or if you're someone with a famous track record of delivering 100 times value,
Yeah.
a venture capitalist might invest in your part-time efforts. But no venture capitalists, and we have several here, are going to invest in something that you're not ready to do full time. Now, they do understand that maybe if you can't live without pay, that they're going to have to invest enough money to cover your basic living expenses. They're going to expect you, by the way, to live in a ramen noodle world. But they're going to want to know that you eat, sleep, and breathe, getting them their money back 6 to 10x. So definitely you have to be ready to cut the strings to whatever else you're doing. Now, there are exceptions, again, for serial entrepreneurs who've delivered over and over. Ironically, those entrepreneurs often don't need the money. And so they're in that situation of turning down money anyway. So bottom line is, if you're ready to go full time and you have traction and you have an app out, you can, in my opinion, you can consider approaching investors because you have a product done that somebody's buying. But you'd have to be ready to go full time and scale it up. Otherwise, if you're not confident and ready to make that move, you have to keep shoestringing it. So does that sound about right, Phil?
Yeah, I mean, my answer almost might sound like Mark Cuban on Shark Tank, which, by the way, is certainly part educational for sure. But if you think more effort would result in better results, prove it by going in full time, just like Ethan said. At that point, when you've proven that you're willing to take that step and show faith in your own abilities and grow a bit more, then maybe you'd be looking for some outside investment. But again, as I'm hearing it today, not making enough money to pay two people, I think you're more of the angel and family and friends realm than the VC realm just yet.
Yep. So, Phil, one question I want to ask you that I'm surprised we didn't come around to. There's this notion, in your perspective, do VCs more invest in the idea or in the team? How do they balance? Obviously, every VC would love to have some brilliant, well-known, proven entrepreneur and an idea that seems like, oh my God, you've discovered bread slicing only better. But how would you say they look at the difference or team versus business plan?
I think they're a real close 1 and 1A because you've got to have a product within an industry that's big enough and growing fast enough and that is timely enough that is going to be show a lot of potential. But on the flip side, you've got to have the team that can pull it off, that has subject matter expertise, that has somewhat been there, done that before. So I think it's a real close. One of them is number one, but the other one's number two, and it may just flip in terms of who the particular investor party is, but they're almost there neck to neck.
Okay.
In my
One second, I'm talking to somebody in chat. I'm curious about a new viewer. We have a new viewer here who has interesting things to say, and I'm just asking him a little bit about his background. It seems like he might be from the venture world somewhere.
Okay.
Anyway, so several people in chat have said team, and I think where I agree with you is ideas are common. I think as long as your idea sounds generally plausible, has some definition, some possible market that sounds big enough, some reasonable plan, then it does come down to team. And the reason for that is most initial entrepreneurial ideas are wrong. In my experience, most entrepreneurs start with a theory and they end up going through several pivots before they arrive at the product that ultimately works if they get to one. And so you're relying on the team to be skilled enough to take a market thesis and adapt on the way. Yes, there are those cases where someone comes up with an idea and they never have to change anything and it's totally brilliant. But that's not, I wouldn't say, normally true. And Phil, I don't know, you've worked at many startups. What would you say, how often would you say the companies you're in have undergone one or more pivots on their way to success?
On average, probably at least once in a company. So I would say almost to some degree every time. So that every time is a big percentage. And I'm going to amend my answer real quick. And that is, if the team is, and I don't have any problem with any particular age. I'm more advanced than probably most people on this call, by the way. But the earlier the team, I think the more important the product. The more mature the team, I think the more important the team, because they've had the chance to have accomplished things before. Whereas someone a year out of school really just, you'd have to admit, doesn't have much of a track record. There's exceptions to everything, but I think it's the more experienced team that would get the higher, vote of confidence from investors. Whereas I think it's more, is this a disruptive, industry altering kind of idea, is more for the earlier stage team.
Okay. And I agree with that. To the entrepreneurs here who have no previous experience, or the wannabe entrepreneurs, you're going to have to sell an idea and on your personality and get people to like not what you've done, but what it appears you have the potential and the energy to do. For the people who have a track record, I have a friend, he's been CEO of 2 previous companies that he's led to successful exits. So he was what was essentially called a hired gun CEO, where he would be brought in to exit a company successfully and return money to investors. And he did that twice, increasing their value and then exiting. And then he decided to found his own company. Well, of course, he had relationships with a set of VCs that he had written checks back to.
Right.
And so there's no way to build a better relationship with a set of venture capitalists or other investors than to hand them back more money than they gave you. And so then when he goes to those folks and says, hey, I have another idea. Last time you gave me $1 and I gave you $3. I think I can do that again. Would you like to give me $1? They're pretty eager to listen, and they're more interested in the fact that he's the one saying it than whatever idea he has. Of course, they also ask questions about the idea.
Right.
But if you're in that situation, that's great. That said, and we have Pentaquan here. He can comment on it. We have some other maybe VCs in chat. Lots and lots of startups. Every startup. Most entrepreneurs are entrepreneurs. Most people raising money are doing it for the first time, not the third.
Right.
That was true. Geez. Every startup I worked at, which is fewer than Phil, we were raising money for the first time. The CEO was a first-time CEO. That was true at this company, Co-Manage. It was true at the company Wisewire we talked about. I worked at another company called Limelight. Not Limelight, sorry, no Limelight. Lightning Cast. First-time CEO. And they all raise money successfully. So it can totally be done. But none of them raise money as easily as my friend who's got 2 exits behind him. Right. He made some phone calls and money showed. Like, it wasn't, of course, it was harder than what I just portrayed, but he made some phone calls and money showed up.
Yeah.
All right. So, let's see, Phil, we've talked for about an hour and 40 minutes. We have a few more questions we could take if you're interested, or I could just ask you, is there anything you feel you'd want the audience to know that you haven't had a chance to share? Like, what would you...
I think, it's almost like keeping score with your peers to have raised a lot of money. And it let's face it, it feels good to raise more. The more money you raise, the better you feel. I mean, that's kind of how it goes. But there is a point at which, you need to be concerned about bringing in more money than you really need, or that you forecast that you'll need. And there's this concept of dilution, and that is the more you bring in, the less you'll probably own unless your valuation is really high. So I think, you can almost be mesmerized by the amount of money you bring in and you have in the bank. But I would just caution to have a more capital efficient mindset. I'm a CFO, what else do you expect? But I would caution from all my experience to, spend the money wisely. Don't go blowing it on things that don't matter, at least for the first, until you're cash flow positive. I would not be real flashy in a lot of areas, is how I'm trying to say it.
Yeah, that's like the magic, right? I remember, this is a story I can tell to close things out. When I said earlier, I weaseled my way into the board meetings in the early rounds of Co-Manage. And Phil, you might remember the details, but somehow we got like $100,000 grant. It was like an entrepreneurship grant or a tax credit, but we got some sort of $100,000 grant from maybe the City of Pittsburgh Innovation Fund or something like that. Sound familiar?
Yeah, it was the Pennsylvania DCED, Department of Community and Economic Development, and altogether between equipment loans, hiring tax credits and everything, I think our package was, it was something like $2 million. And at that point, they didn't really make you keep your promise on having hired the forecasted number of employees. They sure do now.
So that's even more than I remember. But the number I remember is maybe we got the first little dribble of it, and it was $100,000. And we were in the board meeting, and the CEO said, "Oh, we're getting this $100,000." And I piped up and said, "And that's almost as good as revenue because there's money in." And the venture capitalist at the table, one of the wiser ones, Bill Adams, said, no, it's not. Like, yes, it's money, and money's good, but getting paid by someone who wants to buy your product is a whole different thing than having a source of funding. And he was, of course, right. I was ignorant. Not all money is the same. So what Phil's getting at is it's a huge milestone when the amount of money you have coming in can pay your bills, because one, you're no longer dependent on more funding. You can live on what you're getting. And number two, it's just such a huge validation of your value. It's validation of product market fit. So, yeah.
So
So,
I'm going to ask you my first question, Ethan.
oh, go for it.
And that is, what's the most valuable kind of money? Customer money, investor money, or other sources like, banks and things like that?
Well, to me, based on what I just said, completely it's customer money.
Absolutely customer money. Yeah, and I know that's kind of a weird question.
Yeah.
I mean, it's got about 3 to 5 great characteristics. It's non-dilutive. It's actually value enhancing. It increases your value. It's confirmation of your
Product market fit.
and your execution. It's literally 3 to 5 great things.
Yeah. And that's why that isn't this show. We've done it before, but like a big mistake people make is they don't talk to their customers. They have a vision and a dream, and they're committed to that vision and that dream, and they don't understand that it turns out they're the only one with the vision. That there aren't real people who will give real money who are committed to the vision. And that's, by the way, a quick aside on this stream. I choose to stream, and while I love the people who've subbed and a number of people subscribe to the stream today, I don't ask anybody to sub, although I welcome it. And so I give information away for free. If I tried to go to like a sub only or go to selling a course or something, I might have fewer people, but those people who were willing to pay would be huge validation that what I was saying was valuable. Now, I'm not making that change. That's not the point. The point is anybody can give something away for free. That's easy. Getting someone to part with their hard-earned latte or lunch money is harder. So, one more question got a lot of votes. Let's do that, and then I'll let you go, Phil. There are several stories about startups giving too much of their company to investors when raising capital. Do you have insights on how to decide how much of the company to sell?
Well, each round, roughly, you'll hear this it's a loose rule of thumb, is on average about 20% of the company. So you can go out and look those kind of stats up, but that's kind of a generally accepted amount. I would just say when you're starting a company, a startup, that valuation is more art. It's as much art as science, and you've got to be willing to dig in your heels, sell that value, tout that value. Hopefully you've shown that you've got some kind of customer, if not customers that you've actually acquired, at least customer engagement and customer interest that is real. Not just an interested user, like you're an engineer selling to an engineer. So of course you've excited a fellow engineer, but that you've been able to excite decision makers who have budget, decision, and can pull the trigger within a certain time frame. So you need to have, champions of sorts within the customer. But you've got to be a master negotiator and just try to create competition among more than one potential investing parties, and that's where you'll probably have your best negotiating success, is and multiple options.
Just to make sure I heard you right, you said the benchmark is sell 20% of the company and around. Is that right?
Roughly, yeah.
Roughly. So, that varies all over the place for sure. I'm sure you've seen higher and lower. And it depends on the situation you're in.
Depends on your stage. Yeah.
I agree strongly with Phil that that's the ideal. Companies, venture capitalists have an interesting catch-22 that they get caught in. Of course, they want to acquire as much of the company as they can for the least money. But if they starve the company too much for money, then the company doesn't have the money to execute the mission. And so, if $5 would get you 25 back, it doesn't necessarily mean that 3 will get you 15. 3 might get you 0 because you didn't put enough in. The second thing is, and this happens in what they call down rounds. We don't have time to go through everything about a down round, but you can get in a situation where basically the VC can take over the company, but then the founders don't have any equity left. Right. And so suddenly you create this situation where the founders aren't going to get anything if the company succeeds. And that's bad for the VC because suddenly you're putting in $10 million. Sure, you're going to own my whole company, but why should I bother coming to work anymore? And why should my team bother? What's that, Phil?
I'm just an employee now, which is why I probably started a company, was to get away from being someone's employee.
Yep. And so, our Pentaquan, who's one of our VCs here, is talking about how it's important to have the founders probably started a company because they want that moonshot, whether they're motivated by wealth or they're just motivated by being in control and changing the world. Finding themselves in a situation where they're just a guy with a paycheck, they can do that anywhere. Someone with enough chutzpah and success to found a company usually can get a job anywhere. And by the way, one that probably pays better than what they're collecting at their startup. Phil, I don't know Phil's situation, but I'm willing to wager that if he wanted to take a corporate job with his experience, he could raise his daily pay, his at this minute January take home over what he's choosing to get from his startup. You don't have to confirm or deny that. I've speculated on your behalf.
Yeah, I think our CEO might still be on, so I was happy for him to hear that.
I'm sure it's true. And I'm sure your CEO probably knows that. The point is you have to have motivation in terms of equity. Because everyone who works at a startup, even if all they want to do is keep score and they don't really have a burning desire to own an island, they want that chance because it's the prize.
And I think that's where you want the early investors are important in that they are, I keep saying this, emotionally attached or emotionally aligned with you. And just, ideally, you really like each other. There's nothing wrong with liking each other. In fact, that's kind of good. So you can find them out there. It's just, you got to kiss a lot of frogs. And that's why I say start fundraising as early as you can so that you can be more selective and not, if you want to call it, have to settle for certain money.
Yeah. All right. So, real quick, I'm going to distract and say my next scheduled show is next Friday evening, actually. It's an unusual time for me. But we're going to do a 3-way on the show where I'll have 2 different guests. And the one guest will interview the other live in front of us while we watch and keep score. And what I'm doing here is it's an area I'm not familiar with, ironically finance. So we're going to have another CFO, not Phil, come interview. Today is Thursday, so next Friday, 8 days from now. And we're going to have that gentleman interview an aspiring financial analyst. And we're doing that because I want to debug what's going on to help the candidate get a job. He's applied to a lot of places, hasn't landed a job yet. Actually, this is someone you know, Phil. It's Awesome. Oh, yeah. So Awesome's going to be interviewed live on the stream. I didn't ask you to do it because I wanted someone else to do it. And I need to see how he interviews so I can help him. So that's what we're going to do next Friday. Meanwhile, Phil, I'm going to put you on the spot. Okay. We're putting together a show. I need to schedule it, but we're putting together our own version of Shark Tank. Ooh. We do something we call Twitch Pitch, and we've done it once before. And I have about half a dozen of my regular viewers who are willing to come on and pitch their ideas. And one of them asked if you would be willing to come back and be a commentator, so be part of the Shark Tank.
Sure, I'd love it.
All right. So I will warn you, we broaden it a little bit. They won't all be fund my ideas pitches.
Yeah.
Some of them, we tell people that it's about practicing your ability to pitch. So, for example, one of the people may come and pitch why they should get a raise and trial their pitch of, this is what I think I should tell my boss about why I'm more valuable. And so I'll just let you know that you won't only be judging business plans.
No, that's cool. I'd be honored, and sounds like fun.
All right. So I need to schedule that, but Maximus, you suggested asking Phil, and I thought that was a great suggestion. I'd love to have Phil back. I'm going to let Phil go. It's late where he is. He's volunteered a lot of his time. And what we'll do is, I know a few of you have asked questions we haven't gotten to. I will do a speed run of your questions once we let Phil go, just so he can go on with his evening there in East Coast time. So Phil, it's been great seeing you. Thank you very much for taking so much time and for agreeing to come back for Twitch Pitch.
I love it. I think it's an awesome show. I've been watching some of your shows, and you're doing great work, and really just much needed career advice for people. And I think, probably right now with the results of the pandemic and whatnot, there are probably, well, not probably, there are a lot of displaced people, sorry. And people like you are can be a beacon of light for those kind of people.
Yeah, totally. Well, thank you. So Phil, I'm going to go ahead and I'll kill our Zoom, but
Okay.
I'll be in touch and we'll figure out the schedule for that other show here coming up.
Awesome. Thank you so much, everyone.
All right. Cheers, everyone.
Okay. Bye-bye.
Bye. All right. So I agreed I'm going to speed run. Did I get an MMR shot? Yes, Timbo. I ran out that night. The question there is about the virus. Dr. Racaniello indicated that potentially the measles, mumps, rubella. Oops, I got to switch to just me so you're not just looking at a blank screen. Hey, everybody. Yeah, I got an MMR shot, the measles, mumps, rubella. 40 Pink Dragons, I'm just going to take control of the question widget because I'm going to speed run them, so I'll handle it from here. You can sit back and let me drive. I'm going to plow through them. So let's rock and roll. First question is, in your story about financials versus image, do you think, oh, I killed it. Damn. I lost that question. I hit the wrong button. See, this is what happens when I drive. So whoever asked that question, if you're still here, put it in chat and I'll come back to it or re-enter it. There was a question about financials versus image and I lost it. Dummy. All right, I will do better this time. In the past 10 years, seem to involve a lot of software as a service ideas. What are the new ideas of innovation you're excited about? So I'm sure you wanted to know this from Phil. Obviously, Phil's going to tell you self-driving cars, among other things. We didn't get to this with Phil. For me, I think there's the double side of AI. So little has been done with AI and big data. It's still, to borrow a Bezos language, it's day one there. I think there's going to be a ton more innovation in that space. And I think, robotics is something that's about to come of age. You're going to see, self-driving cars are a type of robotics, but you're going to see more and more of that because the mainstream acceptance is starting to get there. So let's see. Okay, so somebody's repeating questions. It was basically, do investors incentivize you to burn cash quickly? Okay, thank you, Smackin9, for regurgitating that question I deleted. My ham-handedness. Let's see. And Zoolander, I see you ask a question. If you put it in, I'd love to answer that one later. If you put it in our tool, I'll speed run to it. So, look, I think Goldman Sachs, in that case I cited, was a product of the situation. Back then, the internet was new. The idea of tech companies was new-ish. And people were saying at that time, oh, it's a new economy. It will never be the same. And so they thought that the old economic model of cyclical expansion and contraction was simply no longer valid, that technology had permanently changed the economic landscape, and they were simply wrong. I don't think they were incentivizing us to burn money so they could own more of the company. I think they were incentivizing us to burn money because they thought that would get them their money back faster. And so from their viewpoint, if they gave us $40 million and they were expecting to get $200 million back, they wanted it back as fast as possible so they could turn it around and do it 5 more times. So I think what screwed them was greed, but it wasn't greed to own more of our company. It was greed to use our company to go own more other companies. And they got burnt. They didn't, I don't know. I had left the company. Phil would know. But they got paid back pennies on those dollars. Like they lost their shirts. And I think, a lot of VCs in that time lost a lot of money. Penta's here. If he's still here, he could tell you how bad the VCs, even if he probably wasn't, I think he's a little young to have been a VC in the 2000 era, but I'm sure he's well educated on the numbers. And a lot of VCs got brutalized in that period. Software as a service, I think, is still a very valid area, but I don't think it's as hot. Like the land grab there of things like Salesforce is probably over, and the software as a service that's going to be invented is going to be more niche. Now, you can make a ton of money in a niche or a specialization, but like the broad areas of exploration of software as a service, I think, have happened. Doesn't mean there won't be a huge company in that area. I just think they're going to have to be either a second generation or more nuanced. Yeah. So Pentequant's definitely talking about, that era was brutal because people invested. And remember, Phil was talking about competition. Goldman was outbidding other people to be our investor, right? So they were giving us more money on better terms than other famous investors. And in that period, that's a dangerous thing for VCs to get into, which is bidding against each other. But they do it. It's a competitive market. And when they get aggressive about it, they take on more risk. And so that's their danger. All right. I'm going to keep up the speed run here because we're almost at a 2-hour show. Actually, we're right at 2 hours, which is long for us. So what are some of your criteria for picking different investments if you have multiple? What's considered a good one? So investments are basically, like we talked about, there's 2 factors. There's team and there's plan. And if the team is good, that's very important. And then on the plan, you're really looking for, is the market big and is there signs of success? Does a company have customers? Do they have contracts? Do they have users? You can turn users into money if they're users of a free product. You can do it through ads. You can turn contracts into money, their commitments for money in the future. What you're ultimately looking for is who's using the product, because you can always improve the product. Okay. Again, you're going to get short answers to this because it's the speed run. What can you talk to what is good timing for different funding phases? When would you wait? Sure. Phil, I know Phil well enough that I can channel him a little on this. He said in his notes to me, you always start fundraising earlier than you think you're going to need it because it's going to take longer than you think. So the first thing to understand, and Pentequant can comment on this, from start to finish, a venture round usually takes at least 6 months. Doesn't mean it doesn't happen sooner, but from the first day you start the process of like writing the pitch deck to the time all the checks are in the bank and you're done is often 6 or more months. In that light, you better have at least 6 to 9 months of money in the bank if you're a venture funded company before when you start fundraising, because the worst situation is to be very, very low on money and be up against a wall where you lose leverage. So the trick in any venture funded company or any company raising money is it's this old joke about I once saw a line in a movie that said a bank will only loan you money when you don't need it. There's a little bit of truth to you better be fundraising when you don't desperately need it. Now, the flip side of that is if you have 2 years of money in the bank or you have revenue and a run rate that you can last for 2 years, raising money, remember, doesn't directly create value. It's a distraction. It's time and effort away from building your product and serving your customers. And so raising money, as much as we love the VCs are here and we can't get things done without them oftentimes, or the angel investors or others, you want to raise as little money as you can, as rarely as you can, while not starving, while not placing your company at financial risk. So that's the trade-off. Whenever you can afford to wait, you wait. Whenever you either A, two very simple criteria, are gonna need money, get on it early, and B, if you're in that incredibly lucky situation where you have provable customer traction and the thing that's stopping you from getting more market share is more people or more product, something money can cure, you have a working model and you simply need to pour energy into it to go faster, you also go get money. That's very rare. And outside of being at Amazon, I've never been in a situation where pouring money in simply allowed me to go faster. Other people may have had that great dream. I've certainly seen it or heard about it, but it's so rare. Okay. Going to keep moving. How do you avoid becoming blinded by the large sums of money? With millions in funds, does the organization tend to become less financially effective in regards to everyday spending? It can. That's definitely, I've seen that happen. That's a lot what Phil was talking about with people wanting to build rock walls and slides and second stories on buildings. It's called Taj Mahal syndrome. And yeah, gosh, you give people a lot of money, they start thinking that they're on easy street and that they don't need, they get distracted. I would say, and I'm no perfect expert on it, we have some health experts in channel sometimes. There is some evidence that intermittent fasting, which I'm not an advocate, but I know a lot of you are Devin Nash's fans. And when I say I'm not an advocate, I just don't practice it. But I've basically that starving your body a little can make it healthier and can have some positive side effects. Foregoing food for a period of time. I'm not an expert on that, but the same thing is true in startups. If you create necessity as the mother of invention and the company runs lean, it will probably be healthier. And it's that same thing of being hungry, quite literally. And so I definitely, Phil was very generous to me where he said I did a great job at co-manage. I certainly did some hard work and did some good things. But I think we did some wasteful things and some mistaken things. And probably if we hadn't had as much money, we wouldn't have done some of the things we did that didn't work out. So yeah, Funky Spinach says Frugality Principle. Look, the key thing is to spend the money as if it's your own, not belonging to some nameless bank. And when I was a younger leader, we made that mistake, right? We spent money like it wasn't ours, like it was free. And that was because, we had this, he didn't tell the whole story. That $40 million round was the company's third round. So the company was given $5 million, then another 20 some, and then another 40. It raised almost $70 million. We thought money would just keep coming. Stupid. So yeah, I would be a lot more conservative now. And like my friend's company, that I said, the guy who's been a CEO a couple times, he's only raised like $5 million. And, he's being much more careful. And I think he has the benefit of wisdom and age. Okay, sweet. Good questions, by the way. I want to compliment everybody who's still here and who asked these questions. These are good questions. They're fun to answer, and I like hard challenges. Okay. Would you work or invest in a high-caliber explosive team for a short-term gain with full knowledge that team will not work long-term? I don't know. I mean, if you tell me for sure we're going to get this gain, I might do that. But generally, I would, like, what you've described here is an artificial scenario. It's an artificial scenario that says somehow this team is going to have great success, but then they're going to implode. And I rarely see that. I think of it in terms of a sports analogy. The sports analogy here is, would I pay for a bunch of high-priced talent to try and make a playoff run knowing that I was going to lose them all the next year? I'm not a sports coach, but I generally haven't seen that work. I'm a big believer in, okay, I read a quote I'm really going to share because I've seen people live it. And I think it's actually a biblical quote. Someone who knows the Bible better than me or is quick on Google can prove it out. But the quote says, "Money quickly made is quickly lost. Money earned bit by bit lives for a lifetime or lasts for a long time." That's a paraphrase, of course, but it's very close to the point. I've seen people get rich or start to get rich and then blow it all. Whereas the slow and steady approach works, and it is Old Testament fam photo. The quotes like Proverbs or something like that. The point is, we hear about the people who get rich quick. They are so much the exception. Oh, there we go. Proverbs 13:11. We hear about them because they're the exception, and they make a great story. When someone puts lightning in a bottle, DT Twitch Hawk, great point. I was talking to one of my stepkids earlier, and I was sharing the story that most people, and this blows my mind, most people who win the lottery are bankrupt within either 2 or 5 years. I think like 90% are bankrupt within 5 years. Again, someone can Google this. It's well established. Because if you take someone who's not earned the money and who's not used to managing money and you give them a bunch of money, they blow it all. And it's not because they set out like, I'm going to blow it all. It's because they didn't earn it and they don't know how to manage it and they don't value it in the same way. And Duke quoted it here. Looks like he's maybe King James version with wonderful gathereth. But wealth gotten by vanity shall be diminished, but he that gathereth by labor shall increase. If you do the work to earn it. So I've spent way more than a minute on a speed run on this. Anyway, bottom line, to whoever asked the question, I wouldn't do it. So we'll move on. As an investor, how many hours per week do you spend checking on or working on your investments? I'm not an investor. I don't know. Phil's a CFO. He's not an investor. Penta, that's his full-time job. I tend, to the limited degree I've ever invested in things, I try to pick investments or people that I don't have to watch and I'm willing to trust. And important, in my case, every time I've made an investment, I've assumed that money was gone. For me anyway, the only way to remain sane is to put the money in, write it off as if I had just had a good meal, and I can't get anything back from that good meal. There's nothing going to come back to me other than the pleasure and the memory. And so there's no point checking up on the good meal 3 weeks later. If eventually I get money back, great. But the only way to maintain sanity, because if I tried to worry about it all the time, I'd go nuts. So Bottom line is, don't invest, and we'll see if Penta agrees. Um, uh, don't, as a personal individual, my recommendation to you is don't invest money you can't afford to write off. Because if you can't afford to not get it back as an individual, you're gambling, because most venture is going to come back as nothing. Actually, Penta, I have a very low risk tolerance, but what I do, therefore, is I invest only stuff I can afford to not get back. And that's why it's a low risk tolerance, because I don't risk anything I can't afford to lose. So that's my way of looking at it. And by the way, I'm not a big angel. That's not my world. My money's in a portfolio of investments, nothing else. Okay. We have 2 questions left, or maybe 3. This is fun, though. Thank you all for really brilliant questions. I love doing this shit. And I like the discussion here has been one of the best we've had. This is so much fun. So let's rock them. What do we got left? If you need to bring on a tech person as a co-founder, how should I structure the equity compensation? That one's a good one for Penta and the other VCs here. Bottom line is, co-founders should get a big chunk, because if you're picking the right person, they're going to be key to the future of the company. It doesn't matter if they're tech or not. It's any co-founder needs to be a co-owner, and in a serious way. Now, Penta would be better than me to talk about the normal distribution of equity among founders. But, in the beginning, the set of founders basically divides up 100% of the equity, and then they have to decide how much they're going to allocate to future employees. And so let's say there's 3 of us and we all divide it equally, and we say, okay, we start out owning a third each, but we're going to have to set aside some for both future financing rounds and future employees. So that third's going to drop really rapidly. You heard Phil say about 20-25% goes to the VCs in each round. The way that works, though, is it's dilutive. So if there's 100 shares, just to pick a number, and each of us would theoretically start with 33, when the first VC comes in, they're going to get 20 or 25 of those, and that's going to come out of each person's 33 mathematically, even if you do it by making more shares. So, and then the next round's going to do the same thing, and that's called getting diluted. Bottom line is, I don't know, I wouldn't join a company as a co-founder for under, well, in this case, I wouldn't do it for under 10% of the equity at the beginning. Different people take different deals, and so I'd rely on others. So, and I see Penta's volunteering his wisdom, which I really appreciate. But look, this co-founder is a partner you're going to trust your company to. You want them, if you don't feel they're worth investing a fair amount of your equity in and sharing some of the upside, you have the wrong co-founder. And that doesn't matter if they're tech or non-tech or whatever. So we're down to all questions with 1 vote. When we get to this point, somebody asked, I'm not going to bother to answer this, how to hire great people, how to fire bad people. That's a whole other show. I've done it before. We'll do it again. You can find some of what I've said out on YouTube. It's a great question, but it's way beyond the scope of this show. Do companies still need early stage funding? Sure they do. Isn't it possible to grow completely natural in today's age by going remote and renting infrastructure? The only capital you would need is human capital. It's more true than it used to be, but not completely true. Example, my friend's company I talked about, he needed to have several PhD data scientists to achieve his mission, which is a big data mission. He couldn't pay those out of his pocket. So, Sublime, thank you for the Prime sub. So he had to raise money. Sure, you say the only capital you need is human capital, but not everyone can be a co-founder. Remember, some of the people you may need to execute your mission can't afford to go with no salary and all stock. So you're going to have money to pay them. So sometimes you have to raise money. That said, the amount, your point of can you work remote and so you don't need an office, and can you use AWS or Azure or something else so you don't need infrastructure and pay as you go? Yes. And so the cost of Pinta, again, could comment on this, but the average cost of founding a startup has gone down in those ways. What else we got? Somebody asked if I've been through an IPO. I haven't. I've seen them, around them, but I'm not going to talk about that because I'm not an expert. I've seen them. It's a lot of work, a lot of financial work. Okay. Opinions on startups that emphasize work from home and global office. I'm thinking about changing jobs and joining a long company. Sure, go ahead. If you want. There's nothing wrong with startups that are work from home. The real question is the startup stable, or can you afford it if one day they stop paying your bills? Some startup founders are either optimistic or unethical, and one day you just won't get paid anymore and you won't have had any warning. So be considerate of how much risk you can take on. Finally, the last question, and someone had asked this earlier, I'll pin this one and we'll talk about it for a minute. Join a Series D startup, greater than 150 million combined funding, 500 million valuation, or big tech as a new software engineer out of college. What type of company should I consider? Should I join a startup, a big one, a small one? Should I join a public company? This all depends on your risk tolerance. Startups are, broadly speaking, more likely to go out of business, and to go out of business unexpectedly with no safety net for you, than, say, publicly held companies. It doesn't mean that publicly held companies don't implode. Enron imploded. Other companies implode or have giant layoffs. But as a percentage, you're more likely to come into work one day and find the doors chained shut at a small startup, whether it's virtual and their virtual chains or physical, than you are at a Fortune 500 company. So the first thing is, what's your risk tolerance? The second thing is, what's your chaos tolerance? A big company is going to have a more structured job for you with more support. A small company is going to have a less structured job, potentially with more opportunity, more chances to do different things, to try different things, to work in different technologies or different areas of the market. I started in startups, and that allowed me to grow rapidly and to learn to do a lot of different jobs. And I switched to Amazon, which is now one of the world's largest employers. And that gave me a chance to enjoy stability because I had been looking over my shoulder. I helped chain the doors shut, at least temporarily, on more than one startup where we were out of money, and I had to tell the members of my team, we don't have any more money to pay you. Our venture capitalists tell us they'll be giving us what's called a bridge loan so that we can pay you 2 weeks from now, but I cannot guarantee that right now. So if you must be paid, don't come into work Monday. If you're willing to take a risk and volunteer, do come into work Monday, but understand it's on you. Now, it turns out my teams always got paid, and the VCs always came through with at least short-term money. But I did that 3 times. 3 times I had to look at my team and tell them there's no more money. If you come in on Monday or whatever day, you may not get paid. Twice at one startup and once at another startup, I had to tell them that. Yeah. By the way, Pentaquant's on a great point. Jack Ma is missing. If you don't know that story, it's worth learning about. The idea that the CEO of one of the largest companies on earth is now not findable. You can feel whatever you want politically. I'm not talking politics. I'm just talking like, that's worth knowing and being aware of. So this question of what to join, if you are confident in yourself and you like the idea of making your own destiny and having broad freedom to try different jobs, but also with the result that you might end up suddenly unemployed, and you can tolerate that and you can go home and live with mom and dad, or you have a little money in the bank and you're willing to live on ramen or couch surf. Startups are an incredibly volatile learning environment. If you don't like crazy and unstructured, and you like having a little bit of structure around your life, and you've done better in classes with a lot of homework and a clear syllabus, or you can't afford to go without a paycheck because you're going to miss your student loans or your car payment, join a bigger company. And you can learn plenty of things and do great things in a larger company too. Because startups, and Pinta will back me up on this, startups, I think he will, we'll guess, startups mostly fail. Mostly. Now, the ones that don't fail pay for everything else. But startups mostly fail statistically. Most of them go under. Most of them crater. If you can be good with that lottery a few times around and get a win, fantastic. Go have a blast. Go learn. Go get your scars, cuts, and bruises, and then you can decide what you want to do. But if that sounds a little bit harrowing to you, and having a boss like me come to you and say, look, we're all out of money. Our funders say they're going to pay all of our paychecks 2 Fridays from now, but I don't know. And that's scary for you. Don't go there. And that's okay too. Go pay off your student loans and go work at a company and get some skills and build up a bank account and then go take that risk. Most of you here, right, statistically Twitch is young. The average viewer is 25-ish. Some of you here skew a little older. Yeah. So Pinta's right there. We expect that most of our portfolio will fail, but that 10% of our portfolio will 2 to 3x and 1 to 2% will 10 to 100x. He's right. So, on average, this stream is a more mature, a more experienced demographic on average than Twitch, but still skews younger comparatively. Bottom line is go take that risk. And look, a mix is great. I know right now the next 2 years of your life seems like eternity, but one day you'll be like me, like it or not, and you'll have had a 25-year career and you'll have had it at multiple places. So go do one, then go do the other. Bottom line, oh, by the way, a Series D startup that's had $150 million of funding is not as unstable as a brand new startup. Like, lots of people have funded that, and it's less likely to just completely crater. It's more likely that if it fails at that point, it will have a fire sale. Fire sale means the VCs may not get their $150 million back, but probably someone will buy the company for something and buy up all the people and use the product. And so there might be some layoffs of the lower performers or whatever. But the odds of them just suddenly chaining the doors shut on a company with $150 million in investment are lower. Not that it can't happen, but lower than a pure startup. So, and that's what Pinta's asking. Is it really still a startup? All right. So we've gone 2.5 hours. It has been fantastic fun. This has been rocking. I've loved answering your questions. I'm glad you appreciated Phil as a guest. I appreciate all of you being here. I will be back 2 Fridays from now. Because tomorrow's Friday. So I'll be back 8 days from now. And we're going to have Austin Patel, who just is one of our mods. He's going to come on. I'm going to have a good friend of mine, Matt McCluskey, who was CFO of the Halo franchise within Microsoft, among other things. So this goes back a few years, but he was CFO of Halo for a couple generations. He's going to come on and act as an interviewer. And he's going to interview Awesome for a finance role. And I'm going to watch. And the reason I want to do that is I want to be able, I can't interview Awesome myself for financial skills. I don't have that background. So I need someone else to do that interview. And then, but I can watch how he responds and I can look for interview behaviors. And so we're going to try and help him improve in how he interviews. And Matt will give feedback. I'll give feedback. And so we're going to do a test drive to try and help everyone learn how to interview better. Because, of course, Awesome will learn, but by commentary of both what he does well and if there's things he can improve, everyone else can learn. And then probably Matt and I will talk some old times. Matt helped me build commerce at Twitch. So he was my leader working directly for me when we rolled out sub gifting and some other things like that. So I'm sure we'll do some Twitch talk as well. So with that said, I may squeeze in another show. We'll see. Look for the announcement. Join our Discord. I appreciate Penta in particular for all the gift subs, as well as all of you who resubbed or subbed with Twitch Prime. I appreciate the subs as a symbol of people who love the channel and the community. And if you haven't, please spread the word about this channel. No, I am no longer with Amazon or Twitch. Licorice, thank you for your resub. I retired from Amazon in September 2020, so 4 months ago, so that I could enjoy life, to have a little more freedom with my time, and so I could do more of this here. So, and Champ Valentine, it was great to have you here. And with that, I'm going to call it a night. See you all soon. We're out of here. Cheers. Oh.